Welcome back. Today we're looking at a very detailed analysis. SOFI plus crypto equals bang. Why this fintech bank is about to explode.
Mm-hmm.
The core argument is that SOFI's Q4 2025 crypto re-entry, especially with their new SOFI USD stablecoin, is the key catalyst for a massive stock price rally.
And I have to say the conviction here is fantastic. The material identifies something genuinely transformative.
Right.
Leveraging that bank charter for safer crypto services, that bank-grade trust premium, it's a really strong intellectual core.
I agree. It makes a really compelling case for why SOFI is different from the Wild West exchanges we've seen before.
It does. But for a prediction this big, we have to go beyond conviction. We really need to focus on maximizing the argument's robustness. That trust premium is tied to forces outside SOFI's control.
Regulation and competition?
Exactly. Which brings us to our first major point. While the analysis leverages that bank-grade crypto advantage, strengthening the long-term thesis requires a deeper exploration of the ongoing regulatory landscape and competitive forces.
Okay, so let's zero in on that. The report says the re-entry is possible because of new OCC guidance.
It does, and that's presented as this sort of magic key that just unlocks the market for them.
But that's where the weakness is.
That's the weakness. There's no analysis of the permanence of that guidance. I mean, regulation is fluid, right? It's been the single biggest risk for banks in this space, historically.
So we're being told what happened. New guidance came out, but not why this new environment is fundamentally safer than the one that forced them out back in 2023.
Precisely. If that foundation is shaky, the whole forecast is at risk. You're selling a moat built on regulatory compliance, but you haven't really detailed the engineering of that moat.
So how does the analysis bridge that gap without, turning into a legal brief?
It doesn't need to be a legal brief. The suggestion here is to add a dedicated section on this, on regulatory durability.
Okay.
The material needs to analyze the key parts of that new OCC guidance and really articulate why SOFI's position is less exposed this time around. Show us why the regulatory environment is structurally benign now.
I like that. It shifts the argument from just trusting a timeline to trusting an underlying structural change.
And that leads right into the other side of this, competition. The analysis does a great job dismissing the unregulated guys, Coinbase, Kraken.
But it completely ignores the chartered competition.
The real threat. I mean, what happens if a JP Morgan or a Wells Fargo launches their own fully reserved stablecoin?
Right. If the only moat is having a bank charter, then that's not much of a moat against every other national bank.
That's the essential question. The analysis has to prove that SOFI's early mover status within this new compliance system, plus their tech stack, Galileo, SOFI USD, gives them an advantage that a big bank can't just easily replicate.
So we need some actual modeling on this. It can't just be a high-level claim.
No, it has to be concrete. For example, take that 2746 stock price as a baseline. Then model a scenario where a huge competitor launches a similar stablecoin in, say, late 2026.
And show how SOFI's vertical integration and proprietary tech insulate that revenue forecast from being eaten away.
Exactly. Show the math behind the resilience. That transforms the thesis from crypto is back to something much more powerful.
To SOFI has the only defensible position in the new regulated crypto economy.
Now you're proving the moat is deeper than just the charter itself, which brings us to our second point. This is about the angle and originality in quantifying the supercycle infrastructure play.
Okay.
The report highlights two massive opportunities. First, you have the near-term retail trading revenue, the 150 to 200 million in EBITDA.
The immediate payoff.
Right, and then you have the long-term infrastructure play. The CEO's vision of SOFI becoming the, quote, plumbing for the entire digital financial system.
And I can see the issue here. The analysis really focuses on that first part, the retail trading number, as the main catalyst for the stock explosion.
It does, and that big strategic vision, notice quote about blockchain being a super cycle technology just like AI, it's kind of just tacked on at the end.
It's bearing the lead.
It is. It's using near-term fee generation to justify the price jump, but it's fundamentally undervaluing what could be a multi-billion-dollar story.
Yeah, if I'm a skeptical reader, that supercycle quote sounds like marketing fluff, unless it's tied to the balance sheet today.
So we need to make it real. The suggestion is to separate these two financial narratives. The infrastructure story isn't just about generating new revenue. It's about drastically reducing operating expenses and increasing capital efficiency,
Which is a much higher quality catalyst for a stock's PE multiple.
a much stronger one. So the analysis needs to show how using blockchain in SOFI's core settlements layer creates measurable value right now.
Even before other fintechs start building on top of SOFI USD.
Precisely. Think about Galileo. Its value is efficiency. If SOFI uses its own stablecoin and blockchain rails for internal transfers, for loan originations, the cost savings could be enormous.
But how do you quantify that? It seems kind of speculative from the outside.
You can model it directionally. Here's a concrete example. Estimate the cost savings based on typical payment processing fees or treasury costs. Compare using blockchain to traditional ACH.
So if using SOFI USD internally saves them, say, 50 basis points on clearing costs across billions in loans.
Then, that cash flow improvement provides real, quantitative support for that supercycle conviction. It's far more powerful than just the retail fees. That model ties the big vision directly to margin expansion.
And it reframes the entire argument.
It does. The material should be restructured to lead with that strategic advantage. Position SOFI USD and the tech platform as the real secret weapon.
And then the retail profit becomes the proof.
Exactly. Use that $150 million projection not as the catalyst, but as immediate evidence that the infrastructure strategy is already monetizing. It's a much more original and defensible angle.
That definitely amplifies the originality. Okay, let's move to our third and final critique, which is all about credibility. It's tone and style alignment.
Right.
To maximize credibility, the language has to match the substance. The analysis is all about bank-grade security and regulatory trust.
But the language is
urgent.
it's highly charged.
And that needs to be recalibrated.
We're talking about phrases like explode, brought a nuclear weapon, betting the farm. They're very high-impact hooks. They're great for a video thumbnail, maybe. But inside the report itself, where you're talking about sophisticated technical analysis like a cup and handle pattern, the hyperbole starts to detract from the rigor.
The tone conflicts with the positioning.
It really does. It suggests speculation and volatility, which is the very thing the report argues SOFI has moved beyond with its bank charter. The language is undermining its own thesis.
Okay, so how do we maintain that sense of conviction without, the high-impact metaphors?
We replace the subjective hyperbole with objective financial justification. The suggestion is to let the numbers do the talking. Let the PE multiple expansion do the heavy lifting.
This means changing the conclusion, fundamentally. Right now, it just says, I am raising my short-term target to $30.
Yes, and instead of that subjective assertion, it needs a quantitative assessment. This is where all three of our points come together.
You mean explaining how this de-risked crypto revenue, supported by the durable regulations and the infrastructure cost savings, actually justifies a higher valuation multiple.
Correct. The analysis should explain with clear logic how this revenue stream justifies a specific PE multiple expansion compared to competitors. That's what logically leads the reader to a $30 or $35 target.
So the price target becomes a product of valuation science, not just enthusiasm.
Infinitely more persuasive. The conclusion isn't, trust me, it's, here is the valuation gap this structural change closes.
And what about the language throughout the report?
You'd replace metaphors like nuclear weapon with institutional terminology. Things like regulatory flywheel or capital-efficient growth driver.
Words that reinforce the structural advantage.
They're just as powerful because they tap into a sophisticated reader's understanding of risk and operational leverage. It reinforces that the explosion isn't a speculative pop, but the inevitable result of a superior de-risked model.
That perfectly aligns the style with the substance.
The core idea here is explosive. The delivery just needs to be more disciplined.